All right, welcome to the inaugural Foundations workshop of the course. Let's see if we can get this one in 15 minutes. I'm going to give you a brief introduction to general market investing and active investing too. And our mantra of the day is trade small, trade often. We want to create an investment to account that has lots of tiny investments in it that are all making money at any different times so that we can kind of make money every day, so to speak. So let's first of all start with the market. Let's start kind of an introductory point. The stock market itself, why is it the most effective investment vehicle for you? So let's just quick look at investing itself. What is investing? I mean, essentially it's just taking risk on your money. You put some money in an investment, you might lose that money, and what you get for risking having that risk of loss is you get paid. It's as simple as that. And many people invest for lots of different reasons. Probably the most common for retirement, maybe earning income, combating inflation. 0.1% interest rates on savings accounts and a 2.5% inflation rate means that you're losing money every year if you aren't earning money on your money. Some people invest to support a company, and some people it is literally just a hobby. They enjoy investing. They might even lose money on it. Well, we all lose money on all our hobbies. I think that's probably the identifying factor of most hobbies. So let's look at some common investment types. These are things that I'm sure you've all heard of. You can invest in real estate, buying, selling houses. You can lend money to people. And I don't mean like as a loan shark. There are actually companies out there that broker lending money and bypass the banks. And I actually use one of those myself. Some people do, angel or venture investing, things like having a rental property. Collectibles, anything from classic cars to Beanie Babies, and things like precious metals and jewelry. Some people literally own blocks of gold, and that's fine. Now, I'm not saying there's anything wrong. Well, I am going to say there's something wrong with these investments. I'm not saying you shouldn't do them. If you want to do one of these things, you should, and I do some of these. But there are downsides to these investments, and we'll go through them one at a time. They are high transaction costs, unpublished prices, and high purchase spreads. So let's talk about these. So high transaction costs, and real estate is probably the best example of this. If you've ever bought and sold a house, you've had to pay closing costs. If you have a real estate agent, you have a lawyer, you have inspectors. These all charge money for you to do the things that are required to buy and sell a house. And it can range anywhere from 1% to 10%. Now, I know you might be thinking if you've ever sold a house, you pay 6% to a real estate agent. That's not 10%. Well, you think about the cost of both the buyer and the seller's costs, both sides of the transaction can easily get to 10%. Of course, you can sell a house by owner. There are ways to reduce this, but you're always going to pay, minimum of 1%. So if you're looking to buy a house, $250,000, excuse me, you're going to pay anywhere from $2,500 to $25,000 just for the privilege of transacting that sale. So that is an example of a high transaction cost. One of the things we'll talk about in this course is a break even point. So if you're looking at $25,000 in transaction costs, your break even point on this $250,000 house is $275,000. That means that you have to sell the house for at least this much in order to make zero on your investment. So that's a high example of a high transaction cost. Let's take a look at unpublished prices. This one's pretty simple. I mean, there are many examples of this, but the idea of unpublished prices is just that you never necessarily know what a fair price is for something. If you've ever, you could do this as an exercise. Take some gold jewelry, let's say it weighs an ounce. You take it to like a pawn shop. How much will you give me for this? And one pawn shop might say $100. Another might say 95. Another might say 115. It's all over the show. You never know what is a fair price because you don't necessarily have an awareness of what is a fair price. And this is true of houses, cars, all of these pieces. The prices aren't necessarily known. It's purposefully that way because they want to be able to make money, and who can blame them? Look at the idea of high purchase spreads. Now, a purchase spread is essentially the difference in price between when you buy something and you want to sell it back. Okay, so let's say you go into a dealer and you buy a piece of artwork for $5,000. And then, a week later, whatever, you want to sell it back. You take it back to that same dealer. They're probably going to give you somewhere in the region of like $3,000 for it. And then there's that classic adage of like you buy a new car, right? You drive it off the lot, lose 30%, whatever. This is examples of purchase spreads. And when this affects you, it affects you particularly when you change your mind on an investment. You want to sell it back. That's going to hurt. I mean, we're talking, it can be anywhere from 10 to 50% just to change your mind. And we should not be penalized for having to change our mind. So that's an example of high purchase spreads. Now, all of these do not exist with the stock market. Number one, transaction costs. Now, depending upon which broker you have, and we'll talk about brokers more in other areas of the course, but a low-cost broker is going to charge you, maybe $5 to buy and sell an investment, and that's whether you buy, say, 100 shares of Apple or 100,000 shares of Apple. I'll use Apple as an example a lot just because they're a very highly traded stock. They're what's called a very liquid stock, so they're very easy to get in and out of. So you buy 100,000 shares of Apple. You could literally do that. You could go into the market when it's open, click buy on Apple, type in 100,000, make sure you've got a decent amount of cash in your account before you do this, and you'll get charged about $5. If you change your mind and sell it back the next day, the same day, you'll get charged $5 again. You got a $10 round trip cost to change your mind. That's a pretty friggin' good deal, in terms of like, I changed my mind, I'm only going to pay $10. Published prices. The stock market is a pure supply and demand market. The CEO of Apple cannot go into the marketplace and say, I want to sell our stock for $150 a share. They cannot do that. What happens is people buy the stock, the price goes up, people sell it, price goes down, and we reach an equilibrium. And that equilibrium is considered the fair price for that stock. It's driven by the people that buy and sell it, which is a beautiful thing. It's not set in any way. So these prices are fair and they're published. If Apple is trading for $120, I can buy it, you can buy it, anybody can buy it, and they will pay the same amount. There's no like weird negotiations or backdoor politics going into this. Everybody pays the same price. So it's a great published, regulated system. Purchase spreads. Now, as long as you choose liquid investments, and we'll look at those in the course, but Apple is an example of a liquid investment, there is the same purchase spread, just like there is in the example of the artwork, earlier on. If you buy Apple, and I looked at the price just before I made this slide here, but let's say it's trading for $119.25. You buy it, and then you change your mind, you want to sell it back, you will have to sell it back for $119.19. So there's a 6-cent spread on a $120 investment. That is a pretty awesome purchase spread. So let's do a quick comparison. If you want to spend $450,000 on an investment. You buy a house. You sell it the next day for $450,000. In other words, you sold it for what you bought it for, right? You're going to lose about $27,000 on that investment. If you were to buy 3,750 shares of Apple, which is roughly $450,000, and then sell it back the next day, you would lose $230. $27,000 versus $230. In a nutshell, that is why the stock market is a great investment vehicle. It's nothing to do with going up, going down, anything like that. It's solely because it is extremely cheap to get into and out of investments. You don't lose money just by changing your mind or by wanting to exit a trade, where in all of the other ones you do. Does this mean you should only invest in the stock market? That's up to you to decide. I certainly do not have all of my money just in the stock market. Now, we're going to shift gears here a little bit. Let's talk about strategic market investing. Now, this sounds, I know, a little marketing term, but essentially what we're going to look at here is you can buy stocks. If those stocks go up in price, you make money. If they go down in price, you lose money. The hope is that over time they go up in price. I think that's pretty plain. Hopefully I don't go into any detail on that. But if that's all there is to investing, this course doesn't need to exist. We want to go into a little bit more detail, give you a way to control your success and become financially literate at the same time. So in this course, we're going to look at a lot more than just buying stocks. And I want to talk to you for a minute about, or a couple of minutes about why you might not want to just buy stocks. Now, before I do that, let me talk to you about why people do just buy stocks. Now, this is really applies to the U.S., but this is the S&P 500, which you don't necessarily need to know what that means right now, but just know that it represents the U.S. economy. And this is it from 1993 to present. And then, there's some ebb and flow here, but essentially it goes up. We live in the United States. We're quite fortunate. The United States has a growth, a growth economy. Our businesses, our nation in general, promotes and wants growth. And you see that every day. If you think about how the U.S. was, say, 10 years ago, 20 years ago, 30 years ago, how it might be in the future, it's constantly changing. I have a 5-month-old. There's a probability that she will not have to learn how to drive a car. That's crazy. Like, there are countries that is not a conversation that would ever be had. No matter what some politicians or what some news media might tell you, the U.S. economy is a growth economy. So if you buy here and you just sit and wait, yippee, I make all this money. It goes from $50 to, let's just say $200 just to make it easy, 4 times of my investment. What I'm going to tell you is that's not enough, number one. Number 2, it's lame. It's so boring. Number 3 is that you never know when you're going to get in, and you never know when you're going to need to get out. Let's say you start investing here, and then you decide, let's say that's 1995 or whatever, and this is 2005. 2005, you need that money for whatever reason. Might be buying a car, clearing some debt, whatever it is. This sucks. You've not made any money. It's been 10 years and you've not made any money. So you look at this chart, everybody looks at these charts and they say, this is a layup. All I do is buy here and sell here. Well, you don't know where you are. You don't know if you're here, you're here, you're here. You never know where you are and you never know where you're going. So we want to look at an investment strategy that allows you to make money. Just make money on your investments, regardless of what the market's doing. So it's certainly okay to buy stocks and just sit and wait, but it's not going to net you money all the time, and you might not make money. You might, in fact, lose money based upon when you need to pull that money out. So what happens is people realize, there's an ebb and flow to the market. So we look at money managers. These are professional people that have, usually, not always, have qualifications in finance. They don't have to have qualifications, just so you know. They just need to pass a test. And they manage your money for you. And to do this, they charge you a fee. And this is, commonly falls under the idea of mutual fund investing. If you have a 401k, you've probably got money in a fund like I do, and you are charged anywhere from 0.5% to 2%. That's not that bad, right? Low percentage to manage your fees. Now, this is the Fidelity Freedom Fund. It says 2000. It's actually 2000 at present. Yeah, that's the chart. This is one of the funds that is available in my company's 401k. This is it from 2000 to present. This sucks. It has made no money. If I got in here and I need my money now, I've made nothing over 15 years. If I got in here, I got out here, awesome. But I never know where here is, and I never know where here is. You cannot see into the future. For this privilege, I'm charged 0.5%. You'll often get quoted that the average stock market growth is about 6% annually. It's somewhere in there. It's a little less than that, but that's fine. If you put in $100,000 and you invested it for 30 years, 6% a year, 0.5% fees, at the end of those 30 years, you would have $75,000 less money than if you would just put that money into the S&P 500, which you can do. So here's my question. Would you rather have $75,000 or would you rather have $0? There is an overwhelming amount of evidence now that fund managers cannot do anything with your money other than what the market does. There are many reasons for that we won't go into now, but it essentially comes down to the fact that the economy is what drives everything. Stocks tend to follow the economy. We live in a global economy now, so buying stocks out of the country doesn't necessarily affect it. We can go into more detail later in the course, but just know this. The data show that fund managers do not outperform the market. So why are we paying them to do it? So the next thing that people think is, okay, well, I'm not going to pay a fund manager. I'm going to pick stocks myself. I'm going to be awesome at this. And they spend hours and hours looking at technical indicators and all kinds of things to produce stocks. Here's some example stocks. I got Lockheed Martin. You'll have heard all of these. They're an arms manufacturer, predominantly Boeing, Aerospace, Microsoft. Boeing and Lockheed, somewhat in the same area, but not exactly. Microsoft is a tech company, totally different area. This is the S&P 500. What we've heard so far is this represents the U.S. economy. Let me just do a kind of general trend of what they've been doing. Notice anything? It's almost like I'm drawing the same line here. They're not exactly the same, but they're pretty friggin' close to each other. Most big name stocks tend to follow the economy. So then people will say, well, what about Netflix? Netflix's graph kind of looks like this. Whee! Right up there like that. How do you know? You cannot see into the future. So you do not know if you've picked the next Netflix. People will publish and say, well, I bought, Starbucks in 1990, and now I've made 1,000% on that investment. That's great. But you also invested in a bunch of coffee shops that went out of business, too. You also invested in a bunch of streaming video services that went out of business. You cannot know. It is pure luck. So what essentially this says, and there is a video that goes along with this from Last Week Tonight, which talks about this, is that if you're going to just buy and hold stocks, the best thing you can do is just buy the U.S. economy, buy the S&P 500. You don't have to spend all that time researching stocks. It's got a positive drift. You will make money over time. The downside to it is what we've talked about so far, is that depending on when you get in and when you get out is going to affect whether you make money. So stock picking is not particularly effective. So let's wind this down here. We're getting towards our kind of 20-minute cap. We're going to look at strategic investing in this course. I'm going to go into all these things in more detail in the course, so don't worry about them right now. But the first thing we're going to do is we're going to use all the vehicles that you have access to. People just use stock. There are other vehicles, predominantly options and futures. These are available to you. They're available. All you need to do is understand how to use them. We're going to look at choosing our own adventure, choosing your entry point, defining how much money you want to risk, how much money do you want to make, spreading your money around so that when you've got things that are losing, you've also got things that are winning, becoming financially literate, getting beyond this 53%. That's that buy and hold. The data show that the stock market goes up 53% of the time. When you buy the market, that's essentially you're capturing that 3%. We're going to look at increasing that 70, 80% of the time, making money. Be in the market, that's going to be easy. I don't even need to go into that in a lot of detail. Something that you'll want to think about, and this will make more sense when we actually start getting in and doing trades, is how frequently do you want to do it? Once a month, multiple times a day. I can tell you that each trade is probably 10 to 15 minutes worth of time. So depending on how much time you have available, depends on the frequency you're going to use. All right, so let's just recap just quickly. We're looking at active investing. This is trading small, trading often, using strategic investing. We looked at the fact that the stock market is the fairest investment vehicle you have available to you. We looked at the fact that the U.S. economy tends to drift up, but depending on when you get in and out of it, depends on whether you make money, which is a frustrating piece. We looked at the fact that picking stocks is not very effective because you don't know what's going to happen in the future, and that stocks tend to follow the market. And we also looked at the fact that fund managers charge you a percentage, and basically you get nothing out of it. So in this course, we're going to look at making you active, understanding your investments, making decisions for yourself. And you can totally do this. So here's just the activity for this one. Just an icebreaker. What's your investing experience so far? You know, maybe keep it like one paragraph, something like that. Just get the conversation flowing in the Facebook group, and we'll go from there. So thanks for watching. Sorry, this one hit 20 minutes, but this is going to be one of the about the longest ones you're going to get. So enjoy, and I'll see you online.